Good morning, and thank you for having me today. So, as we note in our report, the market remains tight, but after a period where we've seen supply undershoot, OPEC production cuts have been taking a lot of supply off the market at a time when oil demand is rising. Now we're seeing, as we head towards the end of the year, we're expecting continued strong growth in demand, but supply is finally on the rise. So OPEC Plus is continuing to unwind their cuts, but we're also seeing higher supplies from other producers outside of the group. So we're seeing that the market is moving closer to balance. So in September, the latest month for which we have final data, we saw OECD inventories dropping by about 50 million barrels a day. It's enormous. Preliminary data for October showing a slight build in stocks, and this is one of the reasons why we're seeing prices already coming off their recent highs. So as we move into 2022, demand is expected to fall seasonally, albeit rising from the pre-COVID levels. And as OPEC Plus continue to unwind their cuts, we're seeing the markets moving to balance. So this is what we had in mind when we're saying that the market is looking less tight as we move ahead.
To what extent are stronger oil prices incentivizing U.S. producers to pump more?
So, as you just highlighted in your introduction, we have increased our forecast for U.S. supply growth in this month's report. Even though the companies, the public companies, are still maintaining their pledges for capital discipline, returning cash to their shareholders, we are seeing an uptick in activity, especially from private companies, but also public independents and major companies are increasing the rig count. $80 WTI are leading to increased rig counts. We're drawing down the DUCs, so we're expecting growth in U.S. supply for the remainder of the year. Next year, U.S. oil supply total liquids up by 1.1 million barrels a day. And so this is really due to the higher prices.